All right, welcome back. Now, in the first half of the year, market turmoil shook investor confidence in the US dollar, resulting in global investors diversifying their holdings to shield themselves from further dollar weakness. According to Sean Neethling, head of investments at Morningstar Investment Management, the cracks in US exceptionalism are making way for emerging markets. He joins us now for greater perspective. Thank you so much for your time, Sean. Now, before we get on to, the landscape that is shaping what is currently happening and also the future, let's actually start off with really what has driven U.S. equity dominance in the past and really what is changing in this landscape?
Yes, so firstly, good evening and evening to you listeners as well. I think we're in an environment, for example, where the market concentration has, been exceptional, not only in the US, but in other parts of the world as well. And I think if you look at that purely through that US equity lens, you've had the so-called Magnificent Seven, and that's largely been driven by that large tech complex. So the NVIDIAs of the world, you can throw Microsoft in there as well. These companies have traded at fairly elevated multiples. And I think what you've seen this year is just investors start to question, the assumptions that you need to justify those prices, seem to be a lot more frothy than what they need to be. So what you've seen as an outcome of that, also in an environment where there's a lot of policy uncertainty with the new US presidency coming in. So I think you've seen a bit of a shift here from sentiment, I suppose, driven allocations, where investors are now looking at emerging markets and developed markets outside of the US for more fundamental allocation. So that's a big part of, I suppose, the theme that you're seeing playing out this year.
Yeah. Is this change in narrative all pegged to tariffs, or are there other dynamics at play here?
Yeah, that's a great question. So I think if you almost split the first half of the year out, DeepSeek seems like a very long time ago, but that was pretty much, investors looking at US tech and saying, there are other parts of the world. The US might not have an unsustainable lead. And that was when you saw the first, let's call it, drawdown in US and US tech in particular. And you saw that initial rally, I suppose, in China tech as an outcome of that. So that was really the first, I suppose, move that we've seen. And then I think, post-Liberation Day, I think, that really spooked investors. It was a lot worse than what the market expected. And I think there what you saw was investors saying, look, ultimately in this type of environment where there's that amount of uncertainty around, what we want to do is hedge our bets as much as possible. So this diversification theme probably became more prominent, and it should have been more prominent coming into the year for most investors. But that's really what you've seen in terms of what's driving these shifts. So one, a very pronounced move where the narrative around the US having the dominance, for example, in tech has been questioned. And then the second part, just the policy uncertainty that you have out of a new presidency has caused a bit of a shift into other parts of the world that are more attractively priced.
Well, actually, what have been the standout features of this emerging market bullishness, and is South Africa involved?
Yeah, certainly. Look, I think when you look at it, South Africa has certainly participated, I suppose, in the broad EM rally. And there's two parts to that, really. The one is really a currency piece. You've seen the US dollar being under significant pressure. It's down about 10% against the basket of currencies this year. So there's a currency effect which is feeding into emerging markets. But then also, if you look at that broad emerging market complex, I think what investors are starting to do is start to break that out. So, before you could think about it as a bucket and largely China. Whereas now, for example, you're seeing other parts of the world. You're seeing Korea, perform particularly well. You've got companies like Samsung and SK Hynix, which is a cheaper play into, I suppose, tech and semiconductors. Brazil and Mexico have performed exceptionally well as well. And then South Africa's really benefited from this risk-off trade. So if you look at the South African rally, it's mostly been sort of platinum counters more recently, and in the first half of the year, really gold mining companies, and that is really feeding into this risk of trade. So we often speak about concentration in the US. The rally in South Africa has also been quite concentrated with those gold and platinum miners, and then maybe one or two other big companies driving those returns.
I mean, the big question really is this a short-term shift or the start of a longer-term trend? And rotation.
Yes, I think in South Africa, we look at it as a fairly narrow rally.
Okay.
And again, we haven't really seen the fundamentals come through in South Africa yet. So I think if you see that, South African companies are undeniably cheap. They trade at very uncompelling sort of, valuations. So I think what we can see, for example, is if you start getting fundamentals coming through, you could see a bit of a shift and a re-rating in South Africa. That's not our base case. We're pretty much on weight South African equities. When we look at emerging markets as a whole, we do think that the broader complex is very attractively priced. And we've actually been in positions where we can take some money off the table. So, a large part of the China thesis is starting to play out. There's one or two really good companies that we think, still has a lot of traction. So something like a Tencent and Alibaba, we think trades at a discount to what fair value is. Our favored, I suppose, regions and countries would be Korea, and then Brazil and Mexico, where we're finding, well-priced opportunities relative to their fundamentals.
And just lastly, as we wrap up the conversation, Sean, how then should South African investors really approach this global diversification in the current environment?
Yeah, I think, the most appropriate way to think about investing in this type of environment is, it's almost a cliche, but to diversify your diversifiers. So I think if you take too big a bet, against or for a specific region or market, that's unlikely to lead to really good outcomes. So, the US is still a very big part, I suppose, of the investable opportunity set. And there's parts of the US market that's cheaper than the more frothy parts. So I think, having deliberate allocations to the US that are more attractively priced, and then finding those pockets of value in emerging markets as well, and then being very disciplined in terms of, when you would enter and exit those different positions. So broad diversification and a bit more discerning in terms of how you go about that.
All right. Well, thank you so much for your time and for your insights there, Sean. Really, really appreciated. That was Sean Neethling, Head of Investments at Morningstar Investment Management.